Dust swirls across the trading floor. The screens flash green and red, numbers jumping faster than your eyes can track. Most people see silver and think, volatile, unpredictable, risky. The kind of metal you trade, not the kind you hold. But here's the thing. Volatility isn't the enemy. Not really. Markets don't tremble at bad news. They flinch when what's invisible starts to matter. When the cracks in assumptions, those invisible ones, begin to widen. Silver isn't misbehaving. It's revealing its dual life. One foot in finance, a hedge against inflation, currency shocks, and instability. The other foot deep in industry, embedded in solar panels, EVs, semiconductors, and the machinery of modern economies. And these two roles don't always pull in the same direction. Sometimes they collide. So before asking if the rally failed or the drop signals doom, pause. Ask this instead. Has silver's structure changed? Because if it has, then sharp rises and steep falls aren't contradictions. They're two sides of the same story. And understanding that story is where real insight begins. The question isn't what silver did. It's why it did it. And whether you're watching the market or just its shadow. January opened with a jolt. Silver futures surged, then reversed almost as quickly. Prices climbed nearly 12% over a week, only to retreat about 10% in 3 days. On the COMEX, open interest ticked higher as leverage positions accumulated, then unwound sharply as margin requirements were raised. Physical inventories in registered warehouses hovered between 80 and 86 million ounces, while outstanding claims, open interest, totaled more than 570 million ounces. That's roughly 7 claims for every ounce of deliverable silver. It's a mechanical mismatch. Paper positions move faster than physical supply could accommodate. Industrial demand, by contrast, remained steady. Solar panel production alone absorbed 200 to 250 million ounces annually, with EV manufacturing, semiconductors, and electronics adding tens of millions more. These flows didn't pause during the volatility. They cannot. Manufacturing schedules, production lines, and embedded systems keep consuming silver even when the market shudders. Since 2021, the silver market has recorded a structural deficit each year. Annual shortfalls range from roughly 110 million to 300 million ounces, adding up to a cumulative deficit between 820 million and 1 billion ounces. This isn't a sudden shock, it's an ongoing strain on inventories. Compared to last month, positions were slightly more concentrated, premiums on physical silver widened in some regions, and exchange flows became less uniform. The combination of leveraged unwinds, tight physical availability, and persistent industrial demand created a temporary but pronounced squeeze. In short, prices moved sharply, paper positions dominated activity, and physical inventories remained limited but steady. Demand did not disappear. Supply could not instantly respond. The pace of change was dramatic, but the underlying mechanics, leverage, open interest, and structural deficit tell a calm, factual story. This was not a crisis. It was a function of structure, timing, and sheer market mechanics. The January gyrations aren't just numbers on a screen. They ripple outward. When paper positions unwind faster than physical silver can flow, it doesn't just depress the price temporarily. It puts stress on the entire infrastructure of the market. Margin calls force traders to liquidate, but physical delivery lags. Warehouses see rising withdrawals, premiums on nearby delivery rise. Arbitrage opportunities emerge, but they're constrained by geography and logistics. Industrial users, solar panel manufacturers, EV plants, semiconductor fabs don't pause. Production schedules continue. That means silver embedded in panels, chips, and circuits disappears from the above-ground pool. It's consumed, locked in, effectively reducing the available supply for future investors. Over time, the accumulation of embedded demand constrains the market even further. On the investment side, volatility triggers repositioning. Funds holding futures contracts must adjust for risk, tightening capital allocations. Smaller players may be forced to exit, amplifying short-term swings. The combination of leveraged positions, unwinding, and steady industrial demand creates a gap between paper claims and physical reality. That gap defines the market's sensitivity. Supply can't just expand to fill the gap. Around 70% of global silver comes as a byproduct of mining other metals, copper, lead, zinc. Even if silver prices spike, miners' production decisions are governed by the primary metal. This creates an asymmetry. Demand can strengthen without a proportionate supply response. Inventories are drawn down, premiums rise, and the market becomes more reactive to any shock. First-order effects, price swings, margin calls, exchange flows. Second-order effects, industrial supply chains adjusting for cost volatility, financial participants recalibrating risk models, regional premiums shifting as some markets face tighter availability than others. Over time, these second-order effects feed back into price and positioning, subtly reshaping how the market functions. The takeaway: volatility is not the anomaly. It is the mechanism through which structural realities, embedded demand, constrained supply, leverage dynamics express themselves. Understanding this chain reaction helps separate temporary price noise from the forces that truly govern the market's trajectory. In other words, when silver moves sharply, it's not only about sentiment, it's about how structural imbalances propagate through every layer of the system, from exchanges to factories to warehouses, and ultimately back into prices. Sharp swings in silver are not new. Look back to the 1970s. A bull market in full swing, prices rising steadily, then a sudden correction of roughly 45% mid-decade. Traders panicked. Headlines screamed. In hindsight, it wasn't the end. It was a pause, a recalibration. Production, investor positioning, and industrial use didn't vanish. The market absorbed the shock and continued upward later in the cycle. Contrast that with 2011. Prices also fell abruptly. Futures were unwound. Margin calls forced liquidations. But the macro environment had already shifted. Real interest rates were rising, monetary conditions were tightening, and the forces driving the bull market were reversing. This decline marked a more decisive change because the context, the underlying drivers, had changed. Today, the situation has echoes of both eras, but is distinct. Volatility in January resembled the mechanical unwinds of prior bull markets, yet the structural deficit and industrial embedding are more pronounced than in the 1970s. Inventories are drawn down, open interest of multiples are high, and physical silver is increasingly consumed in systems that cannot be reversed. Unlike 2011, macroeconomic conditions have not pivoted against silver in the same decisive way. The comparison teaches a subtle lesson. Price alone cannot tell the story. Similar magnitude declines occurred in the past, but the outcomes depended on context. Industrial demand, supply constraints, and embedded usage are far larger factors now than in historical corrections. Historical perspective also clarifies risk. Past volatility within bull markets demonstrates that sharp falls do not automatically signal the end of a move. Conversely, structural shifts in macro conditions, like in 2011, can convert corrections into trend reversals. The difference lies not in the magnitude of the drop, but in what underlies it. In short, history is a lens, not a crystal ball. It filters panic and clarifies mechanics. It reminds us that similar swings can produce very different outcomes depending on inventory, demand embedding, and macroeconomic context. Today's market shares features with past bull markets and past corrections, but it is not identical. Understanding what has changed and what hasn't is critical for evaluating both risk and opportunity. Bull case: conditions for strength to continue. If physical deficits persist and industrial demand continues to grow, then silver's upward pressure could build steadily. Solar panel installation, EV manufacturing, and semiconductor output are unlikely to pause, so embedded demand keeps drawing from limited inventories. If paper markets adjust without forcing excessive liquidations, premiums on physical delivery may widen, signaling that markets are absorbing imbalance rather than breaking under it. If central banks maintain accommodative policies or inflation expectations remain elevated, then silver could retain its dual appeal as both a monetary hedge and an industrial input. In this scenario, leverage positions might unwind in short bursts, but the underlying demand fundamentals support a trajectory of gradual price appreciation. Investors holding physical silver would benefit more than those exposed solely to futures or ETFs, since scarcity is structural. Base case: stabilization. If supply and demand remain roughly balanced, deficits continue but marginally, and industrial flows stay predictable, then silver might enter a phase of consolidation. Price swings could still occur, mechanical corrections, margin adjustments, regional premiums, but these would represent volatility within a contained range rather than directional breaks. If macro conditions neither tighten significantly nor deteriorate sharply, then market participants could recalibrate expectations, positioning themselves for measured movements. Physical inventories would remain tight, but not critical. Paper and industrial flows continue to coexist without major dislocations. In this scenario, short-term traders might see rapid moves, yet longer-term holders could focus on steady accumulation or hedging without being forced to react to sudden systemic shocks. Bear case, decisive trend reversal. If macro conditions shift abruptly, rising real interest rates, aggressive monetary tightening, or currency strength, then silver's monetary hedge appeal could weaken. In parallel, if leverage positions unwind faster than physical supply can accommodate, then the market could experience sharper declines. If industrial demand slows due to economic contraction, reduced solar panel installation, or supply chain disruptions, then deficits could ease temporarily, but that would coincide with collapsing investor confidence. Combined, these factors could drive prices materially lower. If physical supply fails to meet sudden delivery demands, premiums could spike regionally, but systemic stress might outweigh industrial fundamentals. In such a scenario, holders of paper contracts without access to physical metal could be at a disadvantage. Conversely, industrial users with embedded silver continue production, but the market as a whole would be marked by strain, reflecting a misalignment between paper claims, physical scarcity, and investor sentiment. Summary: bull case, persistent deficits, steady industrial demand, accommodative macro leads to gradual appreciation. Base case, balanced flows, moderate deficits, mechanical volatility leads to range-bound consolidation. Bear case, macro tightening plus rapid unwinds plus slowing, industrial demand leads to sharp correction. Each scenario is conditional. None is guaranteed. Each depends on how supply, demand, leverage, and macro conditions interact over time. Understanding the probabilities, not chasing certainty, is the path to professional risk awareness. When I scan the silver market, I'm not following headlines. I'm watching flows, positioning, and signals that reveal stress or stability. US dollar index, DXY. Movements here matter. A stronger dollar can make silver more expensive in other currencies, influencing demand. Weakness in the DXY can lift silver, particularly in its role as a monetary hedge. I track not just the level, but momentum and turning points. Treasury yields. Rising real yields often reduce appeal for non-yielding assets like silver. But the relationship isn't linear. Short-term spikes can trigger mechanical selling in paper markets, even if industrial demand remains steady. I'm observing yield curves for stress signals. Inflation data, CPI and PCE. These numbers shape investor perception of silver's hedge role. If inflation expectations drift higher, silver may attract renewed investment flows. Conversely, sustained low inflation could cool investor demand without affecting industrial usage. Volume and liquidity. Sudden spikes in futures. Volumes or declines in liquidity can indicate leverage adjustments. If contracts roll over or are settled financially rather than physically, it changes how the market responds to stress. Tracking open interest alongside warehouse withdrawals highlights this dynamic. Physical premiums and regional availability. COMEX inventories are just one piece. Regional premiums, particularly in Asia and Europe, show where scarcity is felt first. Rising premiums often precede price moves, signaling stress before it appears in the global average price. Positioning in paper markets. Leverage positions, margin requirements, and claims per ounce of physical silver matter. A small change here can have outsized effects on price because the ratio of claims to deliverable metal is already extreme. These indicators are my lens into the system, not triggers for emotion. They show whether markets are adjusting calmly or under strain, where stress is building, and how physical and financial layers interact. Watching these signals is about understanding mechanics, not chasing volatility. Silver moves quickly, But by tracking the right indicators, you can see the forces shaping the moves before the moves become obvious. This is the difference between reacting and understanding. Silver will move, it always has. Sharp swings are part of its DNA, not a sign that the market is broken. What matters now is recognizing the forces beneath the surface: industrial embedding, structural deficits, and the tension between paper claims and physical metal. This isn't about chasing every spike or panicking at every dip. It's about understanding where stress exists, how supply and demand interact, and which positions are truly exposed. Patience, observation, and a clear grasp of fundamentals will always outperform reactionary moves. This isn't investment advice. It's simply how I'm reading the market right now. If you focus on structure rather than noise, on mechanics rather than headlines, you'll see that volatility is a mechanism, not a mistake. And when silver moves again, knowing whether you hold the metal itself or just a reflection of it makes all the difference.